Welcome back guys to another video. In today's video, I will be delving into the eagerly anticipated 2024 housing market forecast. We've been in this strange market in the last 2 years where interest rates are very high and affordability for most average Americans is out of reach. And it's become even more difficult if you are qualified to actually find a home in this strangely market where inventory is very, very low. So if you are an active buyer and want to know where interest rates are headed and want to know what this year's housing market holds for you, you definitely want to stay till the end. Before we look at the future of housing market for 2024, let's look at the recent past, primarily the last 2 years, and see what events have occurred. Now, I will do my best to talk about these events on a chronological order so it can help us understand and make connection between events. So number one, the first thing that happened, as all of us know, is inflation hit the ceiling after pandemic with the rates being low. A lot of people started to buy houses and inflation was touching 9% towards the end of 2021. And when 2022 came around, let's say the mid months, the Fed started raising interest rates. And we've seen 11 rate hikes till now, where the rates went from being like in the mid 2s to all the way to the mid 8s, and even touching 9 depending on what kind of scenario you are running. And now the rates are sitting at around anywhere from 6% to 6.5%. And inflation is in the low 3s. So clearly their plan, the Fed's plan worked, and by increasing the rates by so much, they were able to slow down consumer spending, primarily speaking of mortgages and real estate, because the housing numbers was one of the biggest contributors to inflation being so high. So they've definitely accomplished that. Then when the rates went high during the mid months, primarily the summer months of 2022, a lot of people were just outright priced out of the market because their mortgage payments went up by 4 times what they were when the rates were lower. So a lot of people put the brakes on, and we saw a slowdown where a lot of buyers just sat on the sidelines and decided not to buy. And this trend started to really take hit around the summer months of 2022. Then we saw the sellers get impacted by these higher rates. Well, a lot of sellers that had locked these really, really low rates during the 2020 time or the 2021 years, they didn't want to sell their home because now they have to go out and buy a home at a higher interest rate. So inventory really started to take a hit towards the end of 2022. And in the month of January 2023, home sales dropped by 30+% compared to the same month the year prior, which was a huge hit throughout existing home sales throughout the country. Then during the summer months, primarily August of 2023, we saw that number, that 30%, go down to 16% year over year. And we saw sales to come back. Sales numbers started to rise because people started to adjust to the new environment. Now, rates had a big play here. They were going up and down, but rates didn't drastically change. Buyers started to adjust and understand that, hey, this is going to be the new market, and people started to come out to buy homes, and a lot of sellers started to put their homes back on the market. Despite all of this happening in the housing market, home prices did not fall. According to CoreLogic's Home Pricing Index, homes throughout the country saw a 6% year-over-year appreciation. And in the last 2 years, we also saw an interesting trend. We saw the southern metropolitan markets have a huge increase in new construction sales. As you can see on this graph, Dallas, Houston, Phoenix, San Antonio, Austin all saw large sales in new construction. And the primary factor for this was companies like Tesla, SpaceX, Amazon, Meta had moved out their operations to Texas to take advantage of corporate taxation. And this trend is still happening, where a lot of people are flocking down that way because there's a lot of jobs out there, and there are homes that are economically affordable, and a lot of the homes are new construction. We also saw a small banking crisis in this country where medium to small size banks, for example, Silicon Valley Bank, closed due to liquidity problems. A lot of these banks had their assets tied into low yield treasuries, and then we saw the interest rates go up, so their main profit sector, which is lending money, loans, had taken a huge hit. Applications that dropped 60 to 70%. Then this news got out that these banks have liquidity problems, and then people started to pull money out, and it created a perfect storm where some banks just outright went out of business. That was the recent past, and the main reason why I wanted to go over the recent past is because the real estate market is very different from the stock market. It is not as volatile where something happens and can just throw the market off whack in 1 or 2 days. It takes time for things to happen in the real estate market. So I didn't look at a decade there, we looked at the last 2 years. And it's very important that we did that because those events are gonna have impact on what is happening in the market today. So now let's look at primarily the city of Fremont here in the East Bay and look at some local numbers to see what is happening in the local real estate markets. What most markets are experiencing, especially here in the Bay Area, is really low inventory, but still a very healthy demand. So what's happening in most cases, this is a great time for sellers, there are multiple offers being put on homes, and in some cases, homes are selling above asking price. Now, they're not selling at the rate above asking price that they were during the pandemic time where homes were selling 20%, 15% above asking. They're still selling above asking, but not as high. So let's look at some local numbers here in the city of Fremont to see what's happening. So we're looking at the January 2024 housing market report for Fremont for detached single family homes. As you can see, in January 2022, 64 homes sold, and that number drastically dropped in 2023, and then in 2024, it was a little bit higher. 35% decrease in inventory. Like I had mentioned earlier, that throughout the country, there was almost a 30% decrease. So this number is translating to the macro level number that we talked about. So 30% decrease inventory sales went from 2022 to 2023. That number has gone up a tad bit, 7% more inventory compared to last year. But here's an interesting number. Average sales price in Fremont in January 2022, which was almost 2 years ago, was 1.828 million. And that number drastically dropped in 2023 because of the rates going up, and it was at 1.5 million. And now again, we see that the average sales price is at 1.804 million, a 20% increase from January 2023. As you can also see on here that sales price versus list price, in January 2022, homes were selling almost 14% above asking price. Then they were just selling right there 99% at asking price. And now again, the trends change where homes are starting to sell above asking. Now this data may not translate exactly in your market, but these trends are happening across a lot of markets in this country where there's just not enough inventory and there's still a healthy demand out there. Thank you for stopping by and checking out my content. If you are getting real value out of this video, please leave me some love and hit that like button and hit that subscribe button to stay on top of your real estate game. Thank you for watching. Now, answering the $1 million question, well, we're already in the end of February. Why have the rates not dropped as everyone was expecting them to drop? Well, number one, inflation went up. Inflation went up in 2 consecutive months, in December and in January. And that inflation, I believe, went up because primarily due to seasonality. We're in the holiday season. A lot of people are buying gifts. There's consumer spending is very high in December. And that is why we saw the inflation go up. And that number bled into January. And I believe, let's see what happens in February. But the Fed didn't do another rate hike, but the rates had dropped a little bit in the beginning of January. But because the January numbers for inflation were not what the Federal Reserve wanted, they were a tad bit higher than December. They didn't raise the rates, but the Treasury bill, the 10-year Treasury yield went up, and those yields are directly proportionate to mortgage rates because that's how investors benchmark risk. So when the inflation went up, Treasury yields went up, and that's why the rates went up. So it's going to be very important for us to watch the inflation numbers very closely because remember, the Federal Reserve is still determined to bring the inflation down to 2%. So if inflation starts to go up even month over month, they won't bring the rates down, and they probably are not going to do any more rate hikes at this point. But when that Treasury yield goes up, the markets adjust, the banks adjust, and then the rates go up as well. So the Treasury yields went up, and that's why the rates went up. So now we're going to have to see what the numbers are for February, and if the numbers come down, then we'll see that Treasury yield go down, and we'll probably start to see the rates come back down to where they were in the beginning of January, probably going to be in that low 6 number. We've come a long way, guys. The rates were at mid-8s, almost touching 9, and now we're in the 6.5. Now, don't take me verbatim for the rates. Your scenario is going to be different. How much you put down is different, right? But I'm giving you an average. Like right now, an average rate would be 6.5%. And we saw these rates go down to like 6.1, 6.25 in the beginning of January. So if the inflation goes down, I suspect the banks to adjust their rates, and in March we should see the rates come back down to the low 6s, but don't expect anything crazy to happen yet. Now, what to expect in 2024 for the housing market? Well, number one, I believe prices are going to stay stable, and we are going to continue to see year-over-year appreciation around the 3 to 5% range. And that is because a lot of people in this country believe in the housing market. That mindset of becoming a homeowner, of having your own space, was again cemented very strongly during the pandemic time, where a lot was happening, especially in urban areas. A lot of people were flocking from urban areas to buy their own space and their own land, going from urbia to suburbia. And that mindset is still very fresh in people's minds. And even the last crash that happened in '08, some people are still remembering how the market rose back up. So people believe in the real estate market, and I believe that is not going to change. And that's why you're gonna see stable prices going into 2024. Number two, we're gonna continue to see an inventory problem. Like I just mentioned, people want to buy homes. People that are able to buy homes are buying homes, and there's just not enough inventory to go around. So demand is high, supply is very low in most markets. It's a very sucky situation for buyers, also for buyers' agents that are helping these buyers, because there's multiple offer situations. You have to make a lot of offers again to get something accepted. However, it's a great situation for sellers, and this trend will continue towards the end of the year, where it'll be a great time for sellers to sell. Again, you have to see what you want to do after that, because you're going to be getting that higher rate. But if you want to sell and you're in a position to sell, it would be a great time for sellers to sell, but a difficult time for buyers because of the low inventory. Number three, I suspect the rates to be where they are. I don't believe the Federal Reserve is going to do a drastic rate drop, because again, like I mentioned, their goal is to keep inflation or bring inflation down to 2%. So what's going to happen if they do any kind of drastic changes? You're going to have a lot of buyers come back in the market, and that's going to raise the inflation up again. So they're going to do this slowly, and if the inflation continues to rise month over month, we might just see the rates kind of just sit there in a gridlock. But I believe if inflation starts to trickle down, we may see some healthy numbers. And by the end of the summertime, I believe that we might see the rates come to the high fives or the mid fives. But I don't believe they're gonna go below that this year, because they're determined to keep that inflation number in that 2% range. So what does all this mean if you're an active buyer right now? Well, like I say in all my other videos, make sure you run your numbers with your loan officer and talk to your real estate professional that you're working with, so you're getting a healthy drip of inventory or homes coming to you, and you can start vetting properties. If the numbers work for you, and you need to really understand what is your comfort level, are you really breaking your wallet, really putting a hole in your pocket? If that's the case, then absolutely don't buy. You want to make sure what your comfort level is and continue to look, because honestly, we can talk about these stats, we can talk about all this stuff, we can look at historical data, but markets are going to do what the markets do, and it might sound cliche, but predicting the market is a loser's game. But if you're buying into real estate and you're buying for a lifestyle, and you're going to know you're going to have that property for 10 years, 15 years, and you're buying this asset for your family, run your numbers, because that asset on a long run will make you money. You just got to make sure if it makes sense for you. Now, if you're a seller in this market, I've mentioned this earlier in this video, it's a great time for you to sell, as the inventory is very, very low, and you can command some great pricing in this market. That's all I have for today, guys. I hope this video was insightful to you. Until next time, this is Karan Singh.